Hi, welcome back. In this, the second of the three sessions on value investing, I'd like to continue the discussion I started in the last session. To review, here's where we are. Value investing, if you look at the 20th century, had a really good run. Good run on two fronts. One was you had the legend of value investing being built up, starting with Ben Graham, traveling through Warren Buffett, the stories about legendary investors and their exploits. At the same time, you were backed up by data from academics showing that low price earnings ratio stocks, low price to book stocks, and high dividend yield stocks all earn more than you'd expect them to given their risk profile. So coming into the century, value investing was in a really good place, even though the last decade of the last century, the dot-com boom threw off value investors a little bit. They felt that they ruled the roost. So here's what I want to talk about now in this session. I'd like to look at perhaps the dark side of value investing. I'm going to argue that even in its glory days, value investing was never as glorious as its proponents made it out to be. And I'll talk about the underbelly of value investing even in the glory days. And then I'm going to talk about the last decade leading into this COVID crisis where value investing seems to have lost its way. So let's start with the glory years. You remember that graph I showed you about low price to book stocks versus high price to book stocks going back to 1928. And if you look at that graph across the entire time period, value investing beat growth investing hands down, right? So you're saying that concludes it. What's left to say? Even in that glory period, here's what the year by year numbers looked like. In 44 out of the 93 years, growth investing actually won. High price to book stocks actually earned a higher return. So this wasn't as if low price to book stocks were up 80 out of the 93 years. They were up 49 out of the 93 years. And in fact, if you look at the year-to-year numbers, you can see there have been extended periods where high price to book stocks, even in the last century, did better than low price to book stocks. So while it's true that if you have a time horizon of 8 or 10 years, low price to book stocks seem to always win. When you pick shorter time periods, there were periods even in the glory years where growth investing won. And if you dig a little deeper at those year-to-year numbers, there are some systematic factors that come through. For instance, it turns out that growth investing seems to beat value investing when earnings growth rates are low, when growth is a scarce resource. Second is the slope of the yield curve seems to happen. When you have flatter or downward sloping yield curves, value investing growth investing seems to outperform value investing, and when you have upward sloping yield curves, value investing seems to win. So there are people even in the 20th century who said, if I can forecast the expected growth in the future, maybe there's a way in which I can win as a growth investor. So that's the first aspect of even in the glory years. While value investing won in the aggregate, there were time periods where growth investing won. Second, even during the periods where value investing won, the reason we say value investing won is low price to book stocks beat high price to book stocks, right? But that's a very loose definition of value investing. In fact, most value investors would say they don't buy just low price to book stocks. They buy low price with good management, low price with moats. Every value investor that I've run into argues that you get a payoff for being an active value investor. And if you look at active value investing, even in the glory years, the results don't look so good. For instance, if you look at actively run value funds, mutual funds, and compare them to value index funds, which you create by just buying low price to book stocks, it turns out that value investing doesn't look that good. So when you look at value investing, even in the glory years, don't get too carried away, because while it looks like it won, it has periods where it lost, and even in the periods that it won, it's low price to book stocks beating high price to book stocks. It's a clear headline. But active value investors didn't seem to beat their own passive counterparts, value index funds. Now, what I'd like to do is break down the payoff to investing based on the different ways in which you can approach value investing. Remember, I said you can screen, you can be a contrarian, you can be an activist, or you can just tilt. You can buy those tilted index funds. Let's look at the payoff to each of these different strands of value investing. Now, Ben Graham's original idea for value investing was screens. And Henry Oppenheimer, in one of the more famous studies of Ben Graham screens, found that if you'd use these screens, you'd have delivered 29.4% a year between 1970 and 1983. I've never liked Oppenheimer's study. I think it is a sloppy piece of research that has been quoted and re-quoted over and over again. Why? 13 years is a blink of time in stock market history. And 1970 to 83 is not any 13 years. It is a 13-year time period where very strange things happen to the market. So if that is your basis for believing screening works, I'm not going to stop you. But to argue that screening works based on that study, I think is overreaching. It is true that if you take the Graham screens and you try them across this 20th century, they seem to deliver excess returns. But here's the interesting feature. Almost all of those excess returns come from the low PE and low price to book screens. Everything else is kind of marginal. The second is whether these value screens work in practice. And there have been companies that have tried to do this, take their value investing philosophy and make them into actual mutual funds. And those funds have had a tough time replicating what they delivered on paper. So is there a payoff to a value screen? Perhaps in some periods of the 20th century, but the evidence is not overwhelming that screening for stocks alone is going to deliver excess returns. So passive screening doesn't work. Contrarian value investing has a mixed message, mixed results. What about activist value investing? Well, of all of the different strands of value investing, the one that seems to have the greatest chance of delivering excess returns is activist value investing. And the reason is you're bringing something to the table. It goes back to something I've said over and over before. If you bring nothing to the table, you will take nothing away. What do activist value investors bring to the table? First, only a small subset of us can be activist value investors. Why? You need hundreds of millions of dollars to be an activist value investor. You and I can't do it. Second, it needs a degree of being a disagreeable personality because you're getting in management face and say, you guys are doing a terrible job. And third, you have to push for change. So in a sense, because very few people can pull that off, the argument might be that, hey, activist value investing should pay off. And the initial results offered some promise. In fact, these are the returns to activist value investors up to through 2007. And you can see that through 2007, activist funds delivered much higher returns than equity hedge funds of the S&P 500. You're saying, what happened after 2007? I will let you be the judge, because if you update the numbers of activist funds through the S&P 500 through 2018, the glory days are clearly behind us. The S&P 500 is in the middle, and in fact, it is unclear that activism is having the kind of payoff that it did pre-2007. Why? Because the space is getting more crowded. There are more people in the space, more people trying to be activists. So perhaps it's no surprise that excess returns are down, but my guess is the very best activists still deliver excess returns. What about index value, these tilted index funds? I'm going to be quite honest. I think the notion of a tilted index fund is an oxymoron. You're either an index fund or you're not. And once you start tilting for price to book and dividend yield, you're trying to just dip your toe in the water saying, look, I'm just going to get a little wet. And I've never had much patience for these factors. It is true that perhaps tilting in favor of higher dividend stocks or lower P ratios might give you a little bit higher return. And the results so far seem to be not so much in terms of higher returns, but better trade-offs in terms of returns to risk. And on that basis, I'm willing to accept that perhaps for some people, tilted index funds might be their replacement for traditional index funds. So let's look at the overall evidence on passive screening. Even the Oppenheimer study notwithstanding, outside of the PE price to book screens, nothing else seems to have delivered returns. And even those screens are not going to deliver returns to active value investors. Contrarian value investing, mixed message, right? The early studies were positive, but then when you took a deeper look at the data, it fell apart. Activist value investing still might be making excess returns, but far less than it did 15 years ago. And index value investing doesn't promise high returns in the first place. Just at the margin, you might make basis points more, 25 basis points, 0.5% more by tilting your index fund. But the ultimate test for me on value investing is how value mutual funds have done. Because if value investing works, actively going out and doing research, then value mutual funds should beat value index funds. In other words, just portfolio of low price to book stocks. And when you look at these studies, at least the early studies, there was no evidence that value mutual funds outperformed value index funds. Well, of course, whenever you bring this up to value investors, their response is, well, what about Warren Buffett? Now, come on. I have lots of admiration for Warren Buffett, but the man is 90 years old. If your response to is value investing working to keep playing the Warren Buffett card, it's a sign of weakness, not strength, that you keep playing the same card. I mean, you have to come up with some new cards. In fact, if you look at value investing in the last decade, the debate is no longer about does value investing deliver excess returns. It's whether value investing can keep up with growth investing. To see what I mean, take a look at what the last decade delivered as returns for low price to book versus high price to book stocks relative to prior decades. High price to book stocks outperform low price to book stocks by more than 5%. High price earnings ratio stocks outperform low price earnings ratio stocks by almost 6%. The last decade has been a losing decade. And if you look at active value funds, 80-85% of these funds are underperforming their appropriate indices, which is a value index. So not only has this decade been a bad decade for value overall, but it's been an even worse decade for active value investing. And even the legends have lagged. If you want to bring the Warren Buffett card, I'm going to play it. And let's face it, Warren Buffett has not had a good decade. I know he's had spots of success. Apple in 2017. In fact, it's ironic that his most successful investment was in a company, in a sector where he said he would never invest 10, 15, 20 years ago. But if you look at the decade and you look at the returns, it's quite clear the bloom is off the rose. And it shows up in how the market is pricing Berkshire Hathaway. Let me explain. Remember, I described Berkshire Hathaway as an insurance company with a closed-end mutual fund. For much of its history, Berkshire Hathaway has traded at a premium relative to other insurance companies. Why a premium? Because you're getting an insurance company plus the greatest money manager in history. Look at what's happened to the price to book ratio for Berkshire Hathaway over the last decade. In fact, by 2020, the price to book ratio for Berkshire Hathaway was lower than that of the industry. I'm not going to draw strong conclusions here because that wouldn't be fair. It's one slice of history. But at least based on looking at Berkshire Hathaway's price, there is no Buffett premium being built into the price. And are you surprised? I mean, markets are not sentimental. They recognize that Warren Buffett is not at the helm of Berkshire Hathaway anymore. I seriously doubt that Warren Buffett had anything to do with Berkshire Hathaway investing in Snowflake, the recent IPO that came out. And Warren Buffett has not been coy about this. 7 or 8 years ago, he told us that he was turning over day-to-day decisions at Berkshire Hathaway to his handpicked successors, Todd Combs. And I will say nothing mean about them. I think they're very good investors. But Warren Buffett was a one-time phenomenon. You can't replicate yourself by just picking people. So that's through 2020. And then COVID hit. And when COVID hit, a lot of value investors thought that this was their chance to get back on top. They said, hey, maybe after a decade where momentum investing and growth investing and buying all these tech companies was the way people invested, now you're going to see the value of buying low PE stocks, high dividend yield stocks. And that was the argument I heard in the early parts of this crisis, February 15th, February 20th, February 25th. But you know what? This crisis has not been kind to value investors. On this page, I have two tables. One breaking down stocks based on PE ratio from lowest to highest, and the second breaking down stocks by price to book ratios. Take a look at both graphs, both tables, and what do you see? The lowest price earning stocks have been the most damaged during this crisis. The highest price earning stocks have been the best performers. The lowest price to book stocks are down. The highest price to book stocks are up. And if you look at dividends, you get an even stronger message. Companies that pay no dividends or low dividends have done much better. They're actually up relative to companies that pay high dividends. If the last decade was damaging to value investing, COVID has been doubly damaging. So here's where we are. In October 2020, if you're a true believer in value investing, you are going, or you should be going through an existential crisis. Everything you thought you knew about value investing is under the microscope. And you're looking for reasons. And I'll give you 4 possible reasons. And from most benign, if you're a true believer in the old-time value investing, to most consequential. The first is you could argue that it's a passing phase. It's true, it's been a very long passing phase, 11 years. But you're saying we've had periods in history like the 1990s where value investing has lagged, but we'll always come back. And the reason this is benign is all you have to do then is wait. Hold on to your Kraft Heinz and your low PE stocks and they will come back. So that's one. I don't think so. But that's my view. The second is to blame somebody. In this case, the obvious blame goes on the central banks, the Fed. Your argument is the last decade investing was skewed by what the Fed did. What did the Fed do? At least in your story, Fed kept interest rates low. And by keeping interest rates low, they rewarded momentum investing and speculating. And they punished good old-time value investing. Maybe that's what you believe. In which case, your prescription is even the Fed can't keep doing this forever. Even central banks at some point in time have to take their hand off the scale. And when that happens, rates are going to pop back up and you're going to be okay. The third possible explanation, and this you're starting to get some consequential reasons, is the investment world has become flatter. Think about it. When Ben Graham listed his screens to pick stocks, to run those screens, you had to go hand collect the data from annual reports. Then you had to enter the data on ledger sheets and use a calculator or a slide rule to compute the ratios. And the very act of screening was so difficult that very few people did it. If you were the one who did it, you deserved a reward. Today, if you want to screen for stocks, it takes 5 minutes. You have a big database. You can run as many screens as you want. The world has become flatter. We all have access to data. We all have access to tools. And if your value investing is based on screening for ratios that anybody can compute, why should you expect to get rewarded? And there's a final factor at play. The 21st century global economy looks very different from the 20th century global economy. Much of value investing was designed to take advantage of the 20th century economy. What does that mean? Big manufacturing companies, book values meant a lot. You bought companies based on dividends. But as the world has changed and we've moved from manufacturing to service, technology rules the world, many value investing metrics have not kept up. Price to book ratios, in my view, have become almost meaningless. So if that is the reason the global economy has changed, then it's time for value investing to look inwards and what do we need to do differently. But here's the bottom line. The years of underperformance are starting to add up. And with each added year of underperformance, I think value investors are moving away from it's a passing phase explanation. 3 years, you can say it's a passing phase. 5, maybe 12 years, we're starting to push the limits of what a passing phase is. And if you blame the Fed, I think it's just a convenient excuse. The Fed has played the Fed has done some things that I don't agree with. But if you keep blaming the Fed, you're not looking inward and asking, what are we doing wrong that's causing us to underperform? It's become a convenient excuse for passing the buck. And finally, especially after the COVID experience, I think we need to accept that the world we invest in is a very different world than the world where Warren Buffett and Ben Graham started investing. We have to rethink how value investing has to be reframed for this world. And that's what my next session is going to be. But I hope you found the session useful. And thank you very much for listening.